As Chief Operating Officer of Houlihan Lawrence, Chris Meyers oversees the day-to-day operation of the company's 25 offices and 1,200 real estate agents. During the 7 years that Chris has been with the company, Houlihan Lawrence has become the largest independently owned and operated residential real estate brokerage serving Westchester, Putnam, and Dutchess County with about 30% of the market share. Mr. Meyers was first introduced to Houlihan Lawrence while he was with McKinsey in Boston. Initially brought in by his sister Nancy Seaman and brother Stephen Meyers for a 6-week consulting gig, Mr. Meyers was bitten by the real estate bug and hasn't found a cure yet. With a strong desire to work with family, a passion for real estate, and an appreciation for the talented team at Houlihan Lawrence, Mr. Meyers joined the company as Chief Operating Officer in 2003. Leading the company's next generation of marketing strategies, Mr. Meyers has successfully integrated the social media strategy into Houlihan Lawrence's services. Inspired by connecting the people that make Houlihan Lawrence great to the outside world and providing customers with accurate market information, Mr. Meyers has been the driving force behind the company's blog, website redesign, and the social media program. Chris holds an MBA from MIT and a bachelor's degree in economics from Yale. He is a Westchester County Association board member and 2008 preservation honoree by the Jade Heritage Center in Rye. He lives with his wife Kathy and 3 children and enjoys golfing and skiing. And without much further ado, Chris.
Thank you, Vijay. Thank you, Vijay, and thank you, Concordia College, for hosting us here this morning. It's a question I get asked a lot is, how's the market when people hear what I do? And usually the best that I can have the opportunity to answer is some version of, good, bad, lately closer to ugly. Actually, the short answer of choice these days is less bad, but it's great to have an opportunity to give a more complete answer to that question and take the opportunity to tell you what is going on in the market these days. Just briefly, although this I think has been covered, those of you who are from here in the Bronxville area are probably pretty familiar with Houlihan Lawrence, since we have been in that little house there going back to the late 19th century, and our roots are with the Lawrence family that owned the business until about 1990 when it came into my family. And we're very fortunate to have just an incredible team of people throughout Westchester, Putnam, and Dutchess counties, the markets that we serve. And in 2009, we will do about $2.3 billion in sales. Now, 2 years ago, that was a number that started with a 4, which gives you a little sense of how the market has changed in the last couple of years. And just to give you a sense of sort of our presence in the Westchester market, we have a leading position at all price levels, but our position tends to grow with price. So this is looking at 2009 through October 31st. There have been about 2,650 or so homes that have sold, and we have been participating on about 40% of those, representing either the seller, the buyer, or both sides. If you get to homes $1 million or more, which is about 1 out of every 6 homes or so, that number grows to about 60%. And you get to $2 million homes, and it's more like 2/3. So we're pretty deeply woven into the fabric of the housing market in Westchester. And when the market sneezes, I guess we catch a cold. And we'll talk a little bit about the market as it is today. But really, before we, I think, get into today's market, it's useful to have a quick review of some of the recent history and how we got here. By now, this story is pretty well documented that we had a bull market in housing on a national level that really began in the mid-1990s. And this is the Case-Shiller Housing Index, the national index, showing that between 94 and 2006, housing prices nationally tripled in value. The index went from roughly 75 to about 225 in a 12-year period, which compounds to an annual growth rate of close to 10%. Now, the economists will tell you that housing prices really shouldn't appreciate by much more than the rate of growth in the economy, so clearly we were getting ahead of ourselves. And that growth was really fueled by, again, a well-documented story, declining interest rate environment, a proliferation of mortgage products, and then eventually a decline in credit standards that really allowed almost anybody who wanted to get access to a mortgage in order to buy a house at almost any price. And in Westchester, we ran with the bulls. We were part of that joyride. And in our area, the median prices of a home went from just under $300,000 to close to $700,000 in that same 12-year period. So our prices didn't quite triple. They're up by about 2.5 times. The red line that kind of cuts across the top is showing the number of homes that sold in Westchester. And you see that it really was running between 5,000 and roughly 6,000 during that entire time. So it was a very active market all throughout that period of appreciation. It's worth talking about a couple of the ways in which our market differed from the national market, because I think it both in some ways insulated us from the housing crisis, but then ultimately I think actually magnified the impact when the financial crisis hit home. Unlike the national market, here in Westchester we have very few investor-owned properties. Almost all homes here are primary residences for people who live here year-round. As we know, it's primarily a commuter community for New York and those who work in and around the New York metro area. And we had very little speculation, very little investors. So while the market in some other parts of the country had a lot of speculative fueled activity, here we didn't necessarily have that. What else was I going to say about that? I think that's, now on the other hand, what I will say is that the same factors driving the growth, obviously the mortgages and the credit, were happening here, but what we also had in addition was that the underlying credit bubble that was fueling the growth in mortgages was also fueling income levels here. We were really home base for where derivatives and all of these exotic mortgage instruments were being created and packaged into new security instruments and sold around the world. And that really helped drive, especially the high end of our market, where we had people who participated in that, were able to earn a pretty good living and turn a lot of that income back into homes. Now, by 2006, it started to become clear that the market had gotten to be rather risky. And as this cartoon illustrates, really in those last days, we were really on very precarious ground, and the market nationally began to really crater around 2006, early 2007. And yet here in Westchester, we chugged on. And again, that gets back to the fact that we didn't have the speculative excess, and what we did have is the financial markets continued to roll along through 2006 and 2007, and so the high end of the market continued to go until 2008. The bull finally caught up to us, and trouble came home to Westchester County. And about a year ago is when things really reached the level of a crisis. All of you, I'm sure, can remember when Lehman Brothers went down, and I know I remember it well. In our family, I have a brother who was at Lehman Brothers at that time. I have a brother-in-law who was the CEO of Bear Stearns prior to that, so this financial crisis hit particularly close to home for my family. And it obviously had a big impact on almost everything in many of our lives, jobs, and obviously housing, which led us to the winter of 08, 09, 1 year ago. Well, there's really only one way to describe the market that we were in at that point, and it was truly just frozen solid. Just to give you a little bit of a sense of that in terms of the numbers. In the first quarter of 2009, about 428 houses to be exact sold in Westchester County, and that's down 60% from what had sold 2 years ago. And I can tell you that, even that number probably understates the true impact, because a lot of those closings were of deals that had been in contract prior to when Lehman Brothers went down. In terms of new business being put together, new contracts for homes, they were almost non-existent. Homes over $1 million in the first quarter were down 75% from the year prior to that. And so while during the period of 06 to 08, when our market was beginning to show signs of fatigue, most of that was at the low end when the subprimes were getting harder to come by. At the high end of the market, we chugged along, and now what we have is actually the opposite. The high end of the market is where we are weakest. Then came the spring, and the thaw began to settle in. I see Cindy Landis here, our manager in our Bronxville brokerage office, and Cindy could tell us the exact weekend, the weekend after Easter, when seemingly a switch turned on and suddenly buyers were willing to step up and make offers on houses again. It was quite remarkable. And then what we've seen in the months since that time is a steady improvement. If we look at each quarter as we go through 2009, we see that the year-over-year change in sales is declining at a slower rate, and the year-over-year decline in prices is also slowing. So in part, we had the seasonal effect of going into the spring market, so clearly more homes were selling. But we also had, beyond just the seasonal uptick, was that we had people who were willing to step up and buy again. And by the way, in October of 2009, for the first month of the year, we actually had more homes sell than a year ago. Now, of course, we are comparing it to what was a very slow period. Although, October of 2009, really, we were closing deals that had largely been put together prior to Lehman Brothers, so we hadn't hit the worst of it. We see just 7% down from the level of October of 2007. And for the first time in October, we have prices that are flat compared to what they were at 1 year ago. If we take that chart and roll it forward to where we sit today, we are now looking countywide at roughly 2003 price levels. So we've rolled back roughly 6 years of pricing. We see that on a year-to-date basis in 09, it's about $590,000 is the median home price. What you see, the red line again showing the units, we are tracking toward about 3,500 home sales in 2009, and that will be the lowest number of sales pretty much on record going back to the early 1980s. And really, I look at that red line as kind of exerting almost a gravitational pull on the price bars that you see. You notice that the red line was going up in the years when prices were appreciating, and as the red line goes down, housing prices tend to follow, usually with something of a lag, which does suggest that we have a little further to correct, and we'll talk a little later about what we think that might look like. But as you can imagine, when you see, numbers like this, depending on whether you're somebody who looks at the glass half full or half empty, pretty much, most people who are homeowners here in Westchester, have, substantial equity in their homes and have realized substantial appreciation, unless you were somebody who bought in the last 5 years or so. And if you are one of those people, and we were selling about 6,000 houses a year, so there's 30,000 families living in Westchester who are in that position, you may be looking at little or no equity. And it's one of the big issues that we see out there today. We do not have here in Westchester a foreclosure crisis. It is out there. I'm not going to say that we have none. It tends to be concentrated in the cities of Westchester. But what we do have are people who have declining amounts of equity in their homes, and in some cases are almost stuck in the house. They can afford to make the payments, they can afford to live there, but they're not necessarily in a position to sell because they'd have no equity to roll out to buy a new home. And so that's one of the reasons why I expect that red line, the number of home sales, while it will bounce back, it's probably going to take us a while to bounce back, because I think we have a lot of people who are more or less landlocked, so to speak, in the home that they're in, and they're likely to stay there. And the kind of mobility that really characterized the market of the last 20 years will be somewhat mitigated. Wanted to take a look at a couple of local market areas around here to just get an illustration of how those numbers play out in terms that are relevant to those of us who live in this area. This is Bronxville and Scarsdale since 2000. And I guess I have a question. As you look at these two markets, is there anything that strikes you that's different about them?
2008 to 9, Scarsdale went up and Bronxville's gone down.
Yeah, that's a good point. In terms of the number of sales, you'll see that Scarsdale has actually gone up in 2009 compared to 2008. The yellow line is the year-to-date numbers through October 31st. The green line is a full-year number, and we've projected out a full-year number for 09. While Bronxville, we're actually trending toward having roughly 30 homes sell, which will be less than half of the average number of homes that have sold in Bronxville, over the last 10 years or so. And you'll also notice that Scarsdale has, and this is no coincidence, the median price in Scarsdale has come back to that roughly 2003 level, where the median price in Bronxville remains pretty close to the peak. We peaked at about $1.9 million in Bronxville in 05 and again in 07, and we're still running close to $1.8 million. And so again, the good news is Bronxville has weathered the storm pretty nicely. I think the bad news is that the relatively few transactions in Bronxville suggest that there is, in effect, it suggests that we have more adjustment to do in Bronxville to bring liquidity back and create a more functioning market. Obviously, also with Bronxville, it's a small community, so few transactions. It's easy to distort. Just as one example, we've had 2 sales in Bronxville in the neighborhood of $5 million in 2009, both of which, one was right at $5 million, one was just under. And those are both higher than the highest sales we had in all of 2008. Now, on the $5 million home actually sold in 2000 for $5 million also. And the people who had lived in it in the interim put quite a bit of money into it. So that's a little bit of how some of these statistics can be deceptive. A $5 million transaction is very nice, but that's a house that obviously it was worth $5 million 10 years ago also. And so has not kept up with inflation or with the cost of carrying it. But really, I think what the dynamics that we expect to see in general around the county The markets where the price has corrected the most are the markets where transactions are recovering the fastest. And that's, I think, pretty intuitive, that as prices come back down to levels that buyers can afford again, that buyers step back in and act to it. The market is very efficient that way. And what we are tending to find in the higher end of the market and communities like Bronxville, like Scarsdale that are higher end, is that adjustment is actually tending to be slower than in other parts. As I think homeowners in the higher end homes have a lot more discretion over whether they sell or not. And those, many of them are choosing not to sell at the prevailing market prices today. We can see this effect as we look at the sales of 2009 compared to '08 by different price ranges. You notice as you go up that scale in price, the decline in the number of transactions increases. With the exception of that range from 2 to 2.5 million where it goes down. I think, by the way, a lot of those are homes that would have traded for $3 to $4 million earlier, and so they've kind of retreated down into that $2 to $2.5 million range and made that price range look like it's relatively healthier. I think it's just reflecting kind of a compression of some of the higher end homes coming down. So as the thaw has come through, what we've been left with is a new market reality, and I'm going to talk about some of the things that characterize this new market. Credit is much less available. Buyers are extremely value conscious, and sellers are really only just now beginning to become more realistic, and I think we still have a ways to go in that regard. Talking about the credit environment, we moved from one extreme to the other. Talk about the easy money environment. 3 years ago, to get a mortgage, roughly 50% of all mortgages that were underwritten nationally were no-doc loans or low-doc loans. They were known as liar loans. Quite literally, you could go in, say, I need X amount of dollars to buy this house. Trust me, I'm good for it. I'm earning enough to cover it. Here's my income. I don't have to show you proof, but I've got, if I have reasonable credit, I'd get that loan. Obviously, that was an absurd environment, and it fueled a lot of, the trouble that we're dealing. Well, now today we have the banks who are left digesting the after effects of their balance sheets being burdened with so many of those loans that have gone bad, and they do not have the liquidity to make loans. Loans that they make are often they're not able to sell again on the secondary market, and so they really can only lend as much as their own balance sheet can hold. And what we have today is an environment where people with excellent credit often can't get loans. We'll take a look at some specifics about that. We're in a market in Westchester, given our price levels, that jumbo loans are really the most significant financing source. A jumbo loan, for those of you who are not familiar, is a loan, traditionally it's been larger than $416,000. That is the threshold above which basically the loan cannot be sold to Fannie Mae, Freddie Mac, or one of the government agencies. In the last year, those standards have been raised for certain high-cost communities like Westchester. I believe the limit now in Westchester is $729,000 for what is called a conforming jumbo loan. Conforming means it conforms to the guidelines of Fannie, Freddie, and FHA. And so we have conventional loans under 419. We have this middle ground between 419 and 729. And then we have the jumbo loans above 729. And pretty much that's the market for $1 million homes and up, is a jumbo loan. 2006, you could get 95% financing for a jumbo loan. In 2009, 25% down is a minimum, and for many lenders, it's actually more than that. FICO is the credit scoring system. In 2006, a 620 score or higher would qualify you for a jumbo loan, and today you need to have a 720 score or more. Reserves, cash that you have on hand after the down payment for the home, used to be 2 months' worth of payments of principal, interest, tax, and insurance. Today, it's 6 months, and actually, in many cases, it's more. I know of one lender that requires, for a jumbo loan, that you have reserves that represent 25% of the amount of money that you borrowed. Appraisals is another big factor driving our environment today. In the old days, an appraisal was a rubber stamp, simply put. For one, comps were very easy to find and to back up the values. But also, we were in an environment where the appraisers and the lenders were really in a symbiotic relationship, and most appraisers did not want to jeopardize their source of business. And so in response to that, there are new regulations on appraisals that have actually had a significant impact in our area. So significant, in fact, that they're being unwound in part. But one of the issues with appraisals is that there are very few comps against which to price the home. As we've seen, there's so few transactions, so there's often nothing to back up the value that's in place. And what we have are appraisers who are actually discounting recent sales for some expectation that prices are continuing to decline. In the old days, your income included bonuses that you received. And in our area, as we know, people who work in the financial community, bonuses are a big part of their income. And today, many lenders will not count bonus as part of your income at all. And if they do, it is given a significant discount. You'd have to show that you earned bonuses in each of the last 4 years, and then you would need a letter from your employer, not guaranteeing a bonus, but basically saying you were still eligible to receive a bonus in years going forward. Jumbo loans are more expensive as well. Clearly, we're in a very low interest rate environment. Again, depending on how you are, glass half full or glass half empty, a lot of people look at this and say, we surely have great conditions for the housing market to recover. Interest rates are low, and that's true. But that also means that interest rates are likely to go up in the future, which will tend to pull down the appreciation rate. Remember, one of the factors that drove that bull market was that rates were coming down from historic highs over a 20-year period. And that was really helping to fuel a lot of that growth. But today, the spread between a conforming loan, less than $417,000, and a jumbo loan is about 75 basis points. I can tell you that this is a significant improvement. Just as recently as 3 months ago, that spread was about 150 basis points, meaning that a jumbo loan was 1.5% more expensive than a conforming loan. If we go back, again, to that 2006 time period, jumbo loans and conforming loans, they were all priced pretty much right the same. They were priced based on risk, based on credit, but there was a very strong secondary market for banks to resell jumbo loans, not necessarily through the government agencies, but they could resell them to other private investors. And so they were willing to price them at the same rates as pricing everything else. And we're now just beginning to see that spread come back into line. I think somewhere around 50 basis points would be a historically normal level for a jumbo loan relative to a conforming loan, and we're getting closer to that level today. We talked about the appraisal environment a little bit, and I alluded to the new regulations. One of the responses to the abuses of the system has been for the banking regulators to require complete independence of appraisers from the mortgage originators. And certainly a good concept. But like a lot of good concepts, it all depends on how you put it into practice. So what that meant was there was a central clearinghouse that would basically appoint an appraiser. This began in April. And when the underwriter or the lender needed an appraisal to get a loan through, rather than hire the appraiser, they had to go to this central clearinghouse who would choose the appraiser for them. And then the lender could have no contact, direct contact with that appraiser. And what started to happen is that this central clearinghouse, in an effort to create autonomy, was bringing in appraisers from different areas, different market areas. So we had here very common to get appraisers from Long Island, from upstate New York, from almost anywhere. And they were not necessarily familiar with what was going on in the local market. We know we had relatively few comps, but they quite literally would not understand how, in Westchester, the school district is really the single most important factor in a home value, and not necessarily just the neighborhood. And we know that in our area, school districts have some strange shapes to them, and school districts and post offices don't always agree. And so we had appraisers who were not familiar with all of those nuances, and in the absence of information, their tendency was to simply go low. And we were getting appraisals that, even though we had buyers willing to pay the price, we had a lender willing to lend at that value, we had appraisers who were saying no, simply because they did not have the information to, frankly, the appraisers were getting risk averse. Now that regulation is actually in 2010 going to be unwound because it had become so, frankly, so challenging to get appraisals that it was really putting a damper on the market nationally. And they are going to go back to an environment where lenders can, in fact, get their own appraisers, but it will be done in a much more controlled way than it was previously. The other thing that we do see a lot of is that appraisers have formulas in which they identify certain markets as being declining markets. Frankly, there are very few markets that aren't declining right now. And what that means is they literally adjust comps down with some time factor. So if a market is seen as having a 15% annual rate of decline, and they have a comp that's 6 months old, they will discount that comp by 7.5% to figure it into their appraisal calculation. And so it becomes something of a self-fulfilling prophecy at that point when the appraiser is basically assuming declines. Those assumed declines are driving how much money can be lent and therefore what the prices of the houses are. So we've talked about the lending environment a little and how it's improving. What we're also finding is that there's really a whole different mentality and a psychology out in the marketplace. And when you look at real estate, like almost any other market, it's driven by the animal spirits, as Keynes used to say. And what we're seeing today is really a different set of values from buyers. Things that were important 2 years ago don't seem to be as important anymore. And it's a little harder to put your finger on, but we'll try to give you some sense of the things that we're seeing and perceiving out there. One is that there is a new value around things that are safety and security rather than material displays of wealth. And again, this is it's a soft concept, yes, but we definitely hear it when we talk to buyers today and what they say and what's important to them. There was a big growth in McMansions in our area, a lot of tear downs and large houses being built on lots, pretty much maximizing the size of the home that could be built on a lot. And we're seeing buyers today don't necessarily want to live in a 10,000 square foot house when they only have 2 children. In part because they don't want to be house poor. Part of that psychology and the dynamic of a couple years ago was basically buy the biggest house you can afford. Your house is always going to go up in value. You've got income, you're young, your income's growing, you're going to grow into your mortgage. And your house is going to appreciate and you'll be glad you did. Well, as prices came down and people realized that in fact there is risk in housing, we are seeing buyers who are even when they can get loans, reluctant to take on more debt than they're comfortable with, or at least their comfort level for debt has really gone down compared to what it had been. Then we get to the emotional factors. You know, real estate is a very emotional transaction, and all the emotion has moved from the buyers now to the sellers. And so 3 years ago, really buyers were willing to get into a bidding war for almost anything. And you know, this card is obviously humorous, but I can tell you it's not that far off from the kinds of things that we saw as far as what was selling for what price. And you would be amazed that, you know, a house like this would find itself, you know, in a bidding war, and 3 people were dying and clamoring to have it, and suddenly it would sell for over asking. And today, all that emotion is now on the selling side. As prices are coming down, what we see a lot of are sellers who really do not want to accept that their home is not worth what it was 1 or 2 years ago. And you know, they say prices are sticky, and we're finding that quite a bit out there. A common phrase we hear is, "I'm not going to give my house away." And you know, we actually, you can show a seller that you're actually selling your house for a price that would have been, you know, you would have thought was great, you know, 4 years ago or 5 years ago, but somehow that's perceived as being now, you know, the prices of 2007 are, you know, an intrinsic right that we have to get. And so the psychology, really, the buyers today have almost no emotion about it. Another thing we often, you know, sellers obviously have a deep personal attachment to their home, in addition to the idea that it's worth a certain dollar amount in their mind. You know, there's all the memories and experiences, and you know, often people, you know, built the home or they added to the home, and you know, what we say to people today is, as soon as you put your home on the market, it's just a house, because that's how the buyers are going to look at it. It's not a home to the buyer; it's a house. So, as a result of that stickiness, what we're finding is, you know, we often look at the ratio of supply to demand, and this is showing again the same price ranges we looked at before for closed transactions. This is comparing the inventory that's on the market, that's the homes for sale column, with homes that are currently under contract and should close within the next roughly 30 to 60 days typically. If you look at the ratio of the active inventory to the homes in contract, you see that it literally goes up with each level in price. So for homes under $500,000, there are 3 on the market for every 1 that's in contract. You get up to the level between, you know, 1.5 and 2 million, there's 15 homes on the market for every 1 that's in contract. And at the extreme, at 5 million and above, there are 27 homes on the market for every 1 that is in contract. Which, you know, we really look at a balance to be somewhere under 8. When the number of homes available for sale is 8 times or less the number of homes that are in contract, they're in balance. And we see pretty much above 1.5 million, we are out of balance right now. So, what does this imply if you are a seller? I want to talk about how you should think about the market as a seller, how you should think about it if you're a buyer a little bit. We're going to play a little game here, The Price is Right. Does everybody remember that game? The pricing strategy when you're putting your house on the market is very, very critical for a seller. And you have 3 choices. Assuming that you can come to some agreement with, you know, hopefully the agent that you're working with about what your home is actually worth in today's environment. The conversations often then go to, okay, so how should we price it? And there's basically 3 strategies. You can price it above the market, and the rationale we often hear from a seller is a combination of, I need room to negotiate, or, you know, maybe somebody, you know, I know you say it's worth $800,000, I'm still going to price it for $1 million because I think maybe there might be somebody out there who's willing to pay $900,000, and we won't know unless we try, will we? Then there's the strategy that says, okay, we say the house is worth $800,000 and we're in agreement on that, so let's price it right at $800,000 and let's assume that everybody knows, and I'm pricing it firm and I'm not going to go, but you just need to know that's my price, but I'm not negotiating. You tell everybody who comes in here, that's the number. And then the third strategy, which is, okay, we think it's worth $800,000, let's go to the market at $775 or maybe even $750 and let the market tell us what it's worth. Now, which do you think is the right strategy intellectually? I hear a lot of people saying at market. Well, what we are finding is that pricing under the market today in a down market is the leap of faith that you need to make. It's emotionally very hard to accept. And I'm sure many of you are thinking, of course he's saying that. He's a broker and he just wants to sell a house. And that would be true. But usually the seller wants to sell a house too. What I can tell you is we happen to have right now, just as an example, there are 4 senior managers within Houlihan Lawrence who have recently sold their homes, at prices that range from roughly around that median price level in Westchester, all the way up into the $2 million plus range, and all of them use this strategy, and at least I'm aware of 3 of the 4 had deals on their houses within 3 weeks of putting it on the market at above asking price. And they had bidding wars. Even today, there are bidding wars on houses. Now, how does that happen? One of the things that happens when you price your house too high for the market is that you get the wrong buyer in there. So if you have that $800,000 house and you've priced it at $1 million, you're getting people in there who think they're seeing the $1 million house buyer has an expectation of what they're going to find. They come into the house, and what they see does not meet their expectation of $1 million house, and they're discouraged. You also get, by the way, far fewer buyers. There are a lot of people, most buyers today, do extensive research before they go out and look at houses. They're online. Our agents can tell you our buyers know more about the market than they do because they're so focused on the area that they're particularly interested in. And they see the houses. They're looking at all the photos online and what the prices are. And there are a lot of people who just won't even bother going to that $1 million listed house because they're just saying that's just, it doesn't make sense. It's not the right price. So you get far fewer people to even come look at it. And then what ends up happening is a few months go by, and the sellers are typically saying, let's give this a chance. We'll see what happens, and then I'll mark it down in a month if I don't get anybody, and we'll see what happens. I can tell you that what that will lead to is a cycle of the seller chasing that market down, because typically they will mark it down a little bit late. Time is not your friend right now if you're a seller. This is, by the way, that strategy, that pricing high strategy, was a strategy that was rewarded for 15 years, because if you were wrong, the market was going to catch up to you sooner or later. The market was rising, and eventually that price would catch up to your list. Well, today it's going the other direction, and so what we have all too often we see are sellers who keep marking the house down, and they usually go just not quite far enough. They never quite catch to where the bid is, and they end up selling the house, and it takes longer, and they sell it for less money than they otherwise would have. Again, back to the manager that we had. She put her house on the market, and this was a $2 million plus house, and she put it on the market just above $2 million in an environment that she thought it might be worth 2.2, and she went to just above 2, and it got into a bidding war, and literally within 2 weeks that house sold for close to $2.3 million. So she got a deal faster, and she got a deal at a higher price than if she had put it out at $2.5 million and waited to see what happened, because buyers are so conditioned. They watch those markdowns. We have on our website, many do today, show me houses that have been marked down. And people just watch those houses that have been marked down, and they perceive that that seller is in trouble, and they're going to wait and watch and see what happens. So the leap of faith is rewarded, and I think that's something that's psychologically or emotionally, it's very hard for most sellers to do. But even in this environment, it is the right answer. Another thought for sellers today, in this environment where you are competing with more houses for fewer buyers, staging is everything. This is obviously a particularly humorous example from what looks like Animal House living room there. But beyond obviously cleaning up and being neat, it's important that you create a neutral experience for prospective buyers who come in the house. We even tell people, take the photos, your personal, your family photos, and minimize them. You want the buyer to imagine themselves living in your house, not to see your family living in that house. And so it's about decluttering, it's about getting neat, and it's also about creating as much of a neutral environment into which a buyer can project themselves. So the combination of pricing it well and staging it correctly, even in this market, you can sell your house relatively quickly, and you can sell it, in some cases, in bidding wars. Got to get every obstacle for the buyer possibly out of the way. Just as another example, we have sellers today who, we have a mortgage company, Thoroughbred Mortgage, which is an affiliate of Wells Fargo Bank. We have sellers who can create buy downs of their mortgage. So you can basically have a program for people who come in that they can get a favorable interest rate for some period of time, whether for 3 or 5 years. And this is something that sellers are doing. Instead of marking the price down, they pay the bank to create this mortgage program, and it's another way to just take obstacles away for buyers of the house, just as a simple example. Talk about buyers and how you should look at the market as a buyer. Obviously, it's a great time right now to be a buyer. You've got more choice. You've got, you're basically buying at prices of 6 or 7 years ago. We talked about how the asking price is everything for a seller. What do you think the asking price means to a buyer? Nothing. When you're a buyer, it is really important for you to form your own opinion of the value of a house and to bid and negotiate accordingly. And it is a very common strategy that buyers look at the asking price as some anchor of what they think the value is. But the problem is you don't know whether the seller, which of those 3 strategies that we looked at the seller is using. We have a lot of buyers who ask us about this information that I'm showing here, and I'm going to show you the information and then tell you why it's not all that meaningful. Mark Twain used to say, right, there are 3 kinds of lies: lies, damn lies, and statistics. And while I am a numbers person, I think this is one case where I don't want to say they lie, but it's not the whole story. This is looking at the average sale price of a home in Westchester compared to the list price. And it's showing a trend line over the last 5 years. And again, it's about averages. We don't know. But what we see is that, in fact, the average selling price has come down quite a bit. In 2004, whether you were under $1 million or over $1 million, it was close to 98% of asking price was the average. And today, it's about 94% for homes under $1 million, and it's about 91% for homes over $1 million. Now, it is interesting that spread has grown wider for high-priced homes. I think that reflects what we looked at earlier. A lot of the high-end market the sellers have not yet adjusted their asking prices. I will tell you that this statistic is also somewhat obscured by the way it's calculated. It's based on the final listing price of the home. That's the way the data comes and is available through the MLS. And so you don't see the effect of markdowns that have happened. You don't see the effect of homes that expire and get relisted again at a new lower price. But a lot of people ask about this number and they say, okay, the average price of a home selling today is about 90% of its ask. So I'm going to go out and I'm going to bid 80% and I'm going to negotiate my way to 90%. And I'm going to use that strategy for every house. I'm going to assume all sellers are alike and that's how I should do it. And what we find is that kind of an approach is not likely to yield a good outcome. Certainly not if they get a seller who's like the person who priced under market. So you really, as a buyer, should not think too much about what and you often hear, by the way, also buyers say, I got a great deal on this house. I bought it for $1 million and the ask was $1.3 million. I got it for 25% off. And in fact, that $1.3 million was not a real number to begin with. And so it's not a way for buyers to think about it. They need to understand what's the value of the house to you compared to other houses and then bid accordingly. And what I will tell you is the market is very efficient that way. A lot, it's back, why does that strategy of pricing low work? It's because buyers understand that typically, and they do bid houses up when they see value. If you're a buyer today, I think I'm stating the obvious here. You should sell before you buy. This is not a time for you to find yourself straddling two homes, and we do see that still from time to time. And we have buyers who get stuck. They've committed, they've got a contract, and then they can't sell their house, and they either have to walk away from the contract, get an extension. Things get messy. This is not a time to try that. If you're a buyer today, you should definitely know what you can afford. You should not just get a mortgage qualification, but a mortgage commitment letter from your lender before you go shopping for houses. In part, it's common sense. You want to know what you can afford, but it really makes you a much stronger bidder. When you know that you can make a bid with a no mortgage contingency, you may still be getting a mortgage, but you can make a no mortgage contingency bid if you know that your mortgage is absolutely committed from the lender, and that will make your bid a stronger one compared to somebody who does not have that. But really, I think the best advice that I could give for a buyer today, in addition to getting off the fence, is to remember that a home is not simply a financial asset. We have so many buyers who are really, really hung up on the bottom, this proverbial notion of when's the bottom going to come in and what price will that be? And they sit around waiting for the bottom to come. And for one thing, by the time it comes, it's probably past. Real estate data is such a lagging, it takes time for those stats to show it. You won't know it's the bottom until the bottom is passed. But meanwhile, life is passing you by. Your home is the place where lifetime memories are created. And, it's a good point to actually talk about another trend we see a lot of out there is rentals. In this market environment, we have sellers who think it's kind of it's almost like a holding pen for people who are waiting to see what's next. We have sellers who think, I'm not going to sell in this distressed environment. I can't get my price, so I'm going to rent my house. We have buyers who think the sellers aren't realistic yet, so I'm going to rent. And I think, I don't have the actual hard data on it. The MLS does not report rentals nearly as comprehensively as they do sales. But at Houlihan Lawrence, we've probably done 5 times the number of rentals in 2009 than we did in 2008. And that reflects both buyers and sellers mutually agreeing, let's just go into a place and sit out this market right now, and we'll find out what happens next year. And again, if you're a buyer, in my view, that's certainly one strategy to take. But you've got to realize that while you're waiting, life is passing you by. So where is the market headed from here? I'm going to make, I guess, uncharacteristically for me, a couple of predictions. I tend not to do this, but why not? And then talk about a few kind of big picture issues that we see affecting us, wild cards, if you will. The worst of the adjustment, I think, is probably behind us, which is not to say that we're really at the bottom, but I think the most, it's like when you're going in a speeding car, it's putting on the brakes that you really feel it, and I think we've passed through that, and we're now driving at a much slower rate, but the adjustment is really behind us. That being said, I do expect that median prices are going to continue to drift downward for reasons that we've already talked about, the imbalance between supply and demand. The high end of the market, I think, still having a ways to go. And what we see, and this is anecdotal, but you often hear about pent-up demand. We think that there's a lot of pent-up supply today. There are people who are in their homes who are, they may have lost their job, or they may have much lower earnings prospects than they once had, and they're hoping that will change, and they're riding it out, and they're waiting for the market to get better. But we hear a lot of them are talking to our agents about what they're going to do in 2010, and I think we will see some people hitting the market in 10 who have been waiting. By the way, it's worth talking about. I've alluded to inventory. Inventory levels today are actually lower than they were 1 or 2 years ago. There are fewer people listed, sort of counterintuitive, but really supply and demand have gone down together. In some cases, we see they're not necessarily in balance, but fewer people are listing their homes today than were listing their homes in the upmarket. And I think it reflects that fact that they have little or less equity than they had, and there's just less of that sense of mobility. People really were very willing and eager to trade up and to move and to sell this house and buy the next house, and I had another kid, so let's go up to the next house, or what have you. And a lot of that seems to have been at least temporarily suspended for the moment, but we do expect to see more inventory come on next year. I also think that if you do buy a home in 2010, you're going to be glad you did. The long run suggests that this will be a very good time to buy a house. I'm not going to say definitively that it's the bottom of the market. I don't know that. But if you have a time horizon of 5 years or more, you will look back and say that 2010 was a great time to have bought a house. I want to talk about a couple issues that really are going to be huge factors in the long-term health of our market. Are we running out of time?
Could I interrupt for 1 moment, because I know some people need to leave for a train to get to work, and maybe this would be a good time to do so, and then we're going to have a few minutes for questions.
Yes. Just briefly, taxes are a huge issue here. I took a median home in Bronxville compared to a median home in Greenwich. In Bronxville, that home has a $31,000 tax bill. A roughly equivalent home in Greenwich, $9,000 tax bill. It's a 3-to-1 ratio. It's a big problem, and something has to give on this. Reform is needed. In an upmarket, it was one thing. Property taxes, by the way, increased 75% between 96 and 06. When the prices are coming down, that just cannot continue. We don't know where jobs are headed. I think clearly if we do not get a strong recovery in the jobs market, it's going to take a long time for the housing market to recover. And Wall Street, which is a big driver of the high end of our marketplace, we're hearing talk of big bonuses coming back in 2010. I think a lot of that money is likely to be deferred or have strings attached to it, in part because of the political pressure. So it's not yet clear that even if those bonuses are announced, that people will have that cash and ready to spend it. But again, I do believe in the long run, we have, in the form of the New York area, the best and brightest people from all around the world continue to be attracted to this market as a place to live. They don't make any new land here. It's very difficult to create new homes, so the supply is fixed, the demand will grow, and I expect in the long run that this is going to continue to be a great housing market. And with that being said, any questions that I can answer for you?